Well, good morning, everyone, and welcome to today's FS Club webinar. It's a real interesting session today because it's something that's been very dear to my heart for many decades, the issue of climate change. And we have here today Steve Waygood, who's going to be looking at how do we go about correcting the world's biggest market failure. Now, I suspect you all know me. I'm Michael Mainelli. I'm one of the people who is delighted to be able to chair some of these webinars because they are fun, fascinating, and friendly. But it's only because we have a wonderful group of sponsors who are enormously tolerant and allow us to range widely over technology, economics, and finance. And we appreciate your support for all the work that we're doing. May I say as well that many of the sponsors here before you have an intense interest, clearly, in the area of climate change, combining either technologies or financial mechanisms to try and address one of the biggest issues of our time. We will, of course, just a little advertisement here, be launching the 6th edition of the Global Green Finance Index next month. So it'll be interesting times indeed. And this year, of course, has been particularly intriguing because we were supposed to have COP26 in Glasgow in November. That's been delayed by a year due to the COVID-19 pandemic, but it's still very much alive and a very, very important subject. And as we effectively get to hit a restart button, maybe we can make COP26 in Glasgow particularly superb. Anyway, the agenda today is, as ever, I'm here to get out of your way so you can listen to Steve. Steve's going to talk for about 20 to 25 minutes about his keynote address on this market failure. And a couple of items. As ever, we really, really do welcome questions, comments, and discussion. Please do use the GoToWebinar facility. I'm here with you, so I'm not on email. You just type your questions in. I'll feed them into the discussion at 10:30 with Steve. I'd also like to point out that Steve has provided a particularly rich and useful set of slides, and he has an appendix to the slide deck, which we're not going to have time to go through today, but it is on the slides here in the audience area, and it is also on the site, and I would encourage you to look at that as well. So with that, no more ado, if I may. Steve, the floor is yours.
Michael, thank you very, very much indeed for the very kind invitation to be here and have a fun, fascinating and friendly conversation with the attendees here. It's a huge, I'm so flattered that you invited me. Thank you. It's an honor. Thank you. So, and also I'd like to thank Peter for helping me particularly navigate the camera issues that we were having, and apologies to you all that we started a few minutes late. So, yeah, just to give you all a flavor of the next sort of 25 minutes or so, we say here it's the world's biggest market failure. We do that intentionally. Defining market failure as the market left uncorrected leads to a suboptimal outcome for society, just getting the definitions out of the way. And also to highlight that the best way of correcting the market failure is to internalize the externalities. And I just want to say up front, investors care. As an insurer, we particularly care because we face an existential crisis if the physical risk isn't addressed. We start to see runaway climate change. So obviously we've been looking at the issue for actually a few decades, and particularly acutely recently. But we can only do so much through our engagement, through our voting, and through our capital allocation. The market failures need to be corrected by government. And that doesn't mean we have no role. We have a very big role in pointing to what could be effective policy and helping the policymakers and the politicians understand how the markets work. I once had the very humbling experience of explaining to the Secretary of State for Business how sell-side investment banks worked, which was absurd but true. And I think we often overestimate, particularly in the political sphere, but also in the policy sphere, just the level of financial literacy. Climate science is complicated by itself, but finance on top of that makes it almost trebly so. Finance isn't taught properly in the national curriculum, so people tend to not understand how their money flows. Now, that's one of the things. So that's the kind of biggest claim. So market failure, investors can correct some of it, but not all of it. But we then had to work with governments to correct the rest. And as an institution, we've been around since 1696. This is the first ever entry in the Aviva Minute Book. And we've been, as an institution, just to flag that not only have we been around for a long time, we're also an asset manager and an asset owner, and we're listed, and we're running pensions, which might not be drawn down for 3 or 4 decades. This doesn't give us a unique insight, but it does give us a very unusual combination of both history and our institutional structure right now. We can see the short-termism of the market.
Steve,
so I just wanted to...
Given our long finance interests here, just out of curiosity, do you happen to know what the claim was for?
I did try reading it a little while ago. No, I don't. I can. Okay. Of course, obviously, this was mostly post. In fact, the whole insurance sector really leapt up following the Great Fire of London. So I imagine this may have been a fire claim. But yeah, no, a little bit of history, I'm afraid. I can't tell you now, Michael, but I will find out. Great, we have a historian within the business. Now, this slide here, you can all read, so I'm not going to read it to you. But there are a couple of points that I do want to highlight. You all, I'm sure, mostly be aware of this, but we've already seen sea level rise because of climate change. Global temperature is already warmer on average by 1 degree post the Industrial Revolution, and we're seeing significant repercussions across the board. I'm going to go on to describe how, but past climates are an indicator of future climates, and unusually in a finance presentation, you're seeing that past correlations are an indicator of future changes. And I'm sure you're all aware of the science here, but for those of you that haven't quite seen it, I find these diagrams, these graphs, particularly stark. And it goes back, the left-hand one talks about CO2 concentration temperature anomalies over thousands of years. And you can see just post the Industrial Revolution, how much of that global land ocean temperature index has risen. So there's clearly a correlation here between CO2 parts per million concentration. Pre the Industrial Revolution, you're talking about 200 parts per million. It is already at 410. And on the next slide, you'll be able to see the projections. If that was the history that we've just looked at, the projections about how we're heading, where are we heading? I find this incredibly worrying. Business as usual is between 4 and 5 degrees. Post the Paris Agreement, even the optimistic policies that are there to deliver the pledges don't take us anywhere near 2 degrees. 2 degrees was set as a threshold because the scientists, as part of the Intergovernmental Panel on Climate Change, told us that it was below 2 degrees that we stood a chance of stopping runaway climate change. And if you can see the scale of change over time that's required in emissions reduction to be able to tap into a 1.5 degree scenario. So this is a stark reality, but I have hope. I have one more slide that isn't hope filled, but tries to give a sense of what do those degrees change mean. Working in insurance, it's often easy to kind of overlook where we're heading and what those physical changes will mean to real people in the real world. On that note, if we hit 3 degrees, you'll see that nearly 3/4 of the population will be exposed to more than 20 days a year of deadly heat. Now, that doesn't mean they need to migrate because, of course, air conditioning units can allow people to live today in Dubai, but it does mean they will probably need to migrate. And Siberia, as it's melted at this point, the permafrost will have melted. But that is predicted to become valuable real estate at 3 degrees. You're talking about the Alps looking more like the Atlas Mountains. You're talking about rainforest dieback. And this is why the feedback loops that take us way beyond 3 degrees will start to kick in. If the lungs of the planet, the rainforests, are no longer functional, and if the Siberian tundra has melted, the amount of methane that will then be released into the atmosphere, which you may know is 21 times more damaging than CO2, will be of such scale that we'll see the further tipping points reached and breached. And just to also flag at the other end of the change, even at 1.5 degrees, if you look to the natural environment slide, we'll still see extensive reef decline, 70 to 90%. Now on this slide, this was a study that we sponsored with others back in 2015. It's a £500,000 piece of research, and it looked into what are those various different degrees of change. What might they do then to using the best available economics and science? What would happen to the stock of available financial capital? Now, in this case, we were looking at the value at risk in 2015 to different scenario changes by 2100. The worst scenario was a 6-degree scenario, which is plausible, but thank God unlikely, incredibly unlikely, but still nevertheless plausible. At the time, the present value of a 2100 6-degree scenario was $43 trillion would be wiped off the stock of capital. $43 trillion. That was the present value of the future hit. So if you recount it 85 times, you were talking about nearer a 200 trillion hit. And most of the damage in that kind of scenario has been beyond 2070, 2080, and up to the end of the century. And the reason why I'm laboring that point is that a lot of the time, even within the Task Force on Climate-Related Financial Disclosure, which I'm very proud to sit on, a lot of the time we're talking about scenarios that take us up to 2050. Of course, net zero by 2050 is key. Brilliantly, we're seeing China now aiming at net zero, but unfortunately by 2060, a huge statement that needs to be faster. The point I'm making here, though, that the physical risk gets most acute the longer you look out. It's obvious in a sense, but it doesn't bite. When people ask us as an asset manager or an insurer to do stress tests over 3 and 10 years, they don't really come up with a conclusion that says we should worry. It's only when you start looking out through the runaway feedback effects, the runaway climate change impacts, that you start to become acutely worried. Now, on this slide, you'll see the speed of change that transition requires to hit 1.5 degrees. Obviously, if we'd started in 1980, we'd have had a much, much easier ride at transitioning, but the precipice that we're now facing into is vast. The carbon bubble, I see that from Carbon Tracker, and a brilliant organization done phenomenal work. And what you can see there is that, if you like, the proven and probable reserves of the fossil fuel sector, roughly 3 billion tons of CO2. Of that, how much of that can we use? Just about 500 billions, approximately, 500 billion tons approximately. So the delta between the 500 and the 3 billion is what's often referred to as potentially stranded assets. And if the market wakes up to the fact that those assets will be stranded collectively, simultaneously, then we're looking into a Minsky moment where, and as you'll all know, that rapid readjustment of prices can lead to an erosion of value, can lead to people's pension savings and investments, the valuation rapidly adjusting down in this case. Now that should be a worry, particularly if you've auto-enrolled into a index tracking pension scheme, because your money will simply follow the index down. This is the place where active managers will seek to generate alpha and exploit excess returns. So I said this was supposed to be fun, fascinating, and friendly. It's certainly not been fun yet. I hope it may have been fascinating. So what I want to do now is talk about hope. Now, this slide for me gave me hope. I saw it from the UN Environment Programme Finance Initiative, the inquiry, the UNEP inquiry, I should say, led by Nick Robbins and Simon Zedek. It's a phenomenal piece of work. And one of the conclusions they drew back in 2016, if you look at the blue bar here, that is the increase in policymaker intervention in the system, trying to correct financial markets, not the real economy here, financial markets with policy on sustainable finance. That bar gives me hope. The recognition that climate change is a market failure, that a lack of sustainability in the system requires market correction. This post-financial crisis, you can see it particularly picks up. That this shows me that whether it's the IOSCO, the International Organization of Security Commissioners, whether it's the Dutch Central Bank, the Financial Conduct Authority, or the Financial Stability Board setting up that task force that I referred to earlier, or the European Commission's work. The picture you see there is the front cover of the high-level expert group report. Again, very proud to play a role in that group. An amazing set of conversations, phenomenal recommendations that have come out that are beginning to really bite. That gives me hope. In addition, not just the policy response, particularly in Europe. In addition, I'm seeing that the policy response that we're seeing being driven by the Network for Greening the Financial System, now over 50 central bank governors. In fact, I think we're approaching 70 central bank governors. Similarly, the Finance Ministers Network for Climate Change, the fact that finance ministers are even talking about climate change now, let alone have a network. This is the stuff that gives me hope, because the top tables at the UN, at the OECD, at the World Bank, at the IMF are recognizing that the climate crisis is driven by markets, not just the real economy. And as I've already acknowledged, we need to address the price of carbon, internalize it so the cost of capital reflects a genuine cost of carbon, but also preparing the financial services system so that it's ready for this transition. We need to manage a transition towards a lower carbon economy, and a well-managed transition requires policy makers to ensure that we neither dive into the abyss of the physical risk that we're facing, nor do we experience that Minsky moment, which also would erode huge value. We need to transition the economy in a well-managed way. That is enormously challenging. So we worked with Accounting for Sustainability, Financing Our Future. It's about 100 pages, 40 chief execs of some of the world's biggest financial institutions helped come up with the ideas that are in that report. We've also, of course, been doing our own climate change reports, and there's this one you can see there. There's also a Marshall Plan for the Planet that we published last year. First ever climate change strategy was in 2015. We're actually advocating that all financial institutions mirror the COP process, the Conference of Parties process that we set out we actually set out an institutionally determined contribution, as I think of that, before Paris. It was our first climate change strategy. We did a stock take in 2018 alongside all the other member states who signed the Paris Agreement. And we're about to publish our 2020 strategy on climate change. Now, in 2012, we did this roadmap for sustainable capital markets. And then on the next slide, we turned that UN-facing document, trying to educate the United Nations policymakers about how the markets work and how they could harness them. We turned that into an online toolkit for then the European Commission to use in building that Sustainable Finance Action Plan. Now, this toolkit remains online. It's no longer in date because the recommendations that actually the high-level expert group made, all of the recommendations in the toolkit were made again in the high-level expert group, which then in turn have gone on to shape policy. But the toolkit still exists. And on the next slide, you'll see the graphic that we use to educate not just the policymakers, but pretty much everybody. Now, we worked with the European Political Strategy Centre to create this graphic, but it's really, you need to think of it more as a cone rather than as in this case, a flow chart. Now, the reason why I say cone, you'll see individuals are on the left and on the right. So clearly you can be an individual worker and a consumer. But we're going to take, for what we do with the policymakers, you as individuals, your money in different markets works in different ways, but it's broadly like this. You will use maybe a pension, which is regarded as an asset owner, so as an insurance company or retail bank. In many markets, those asset owners will use investment consultants to choose a fund manager. And the investment consultants, there's only a dozen or so that really matter. They're not well known, they're not very public, they're not actually that regulated, but those investment consultants choose a fund manager for the asset owner. Maybe every 2 or 3 years, there'll be a review of whether the fund manager is the right one. We, in turn, I work at Aviva Investors, not on the insurance side, on the investment side. So colleagues of mine will buy and sell companies on a stock exchange. If it's a listed equity, of course, if it's a real asset, it won't go through the exchange. We could buy, for example, a commercial building or an infrastructure asset away from the exchange. And so, for example, we're the UK's biggest investor in UK rooftop solar. We're also a big investor in offshore wind. Now, continuing the flow of money, the stock exchange will take a little bit from the transaction to fund its own business. The money then flows into the investment bank, which again is a business model that's based on turnover. And the sell side investment bank, of course, that will underwrite the equity or the debt that the company issues. And it's at that point where the company gets the money that it puts it to work to shape the future we retire into, to do all the various things you can see those icons deliver, whether it's flights or fuel. And then it generates a return on investment that flows back to you either in dividends or an improved share price or in the payment on the corporate bonds that we have lent money to the company via. So that's the system. That's how it works. The credit rating agencies oversee. There's three that matter. They cover 98% of the market. S&P by itself has 75% of the market. And roughly speaking, the world's top 25 asset managers run well over half of the assets under management. So what I've given you is a flavor of how business models change and a flavor of how there is huge concentration in the system. Now, if we're going to harness that system, sorry, if you can keep it on the previous slide. If we're going to harness this system, then what you need to do is to understand how that system is overseen, how it's controlled. We need to look at how its transparency operates, not just the companies, but also how the asset owners and the asset managers use the information. This is the whole ethos behind the TCFD, and it not just asking issuers to disclose, but also the users of data. We also need to understand their business models and how in some cases they're machines for short-termism. Stock exchanges used to be quasi-regulators. They then became for-profit. They then listed on their own stock exchange. They then made their executive focus on total shareholder return or other measures of share price improvement in order to then generate their bonus. So we took effectively a machine that was supposed to be for exchanging securities in the interests of everyone and turned it into, to some extent, a machine for short-termism. I don't see very much discussion about that. Now, if we're going to understand the system and intervene, the listing code for the stock exchange, the way brokers are paid, the way fund managers are incentivized, the stewardship codes that we're expected to perform with, the codes that set out how companies should list, what kinds of information they should put into the market, the way asset owners' fiduciary duty is described, the way that listed companies' fiduciary duty also to their shareholders is described. All of these need to be reconsidered and rethought through the lens of climate change. And that lens is a very long-term one, as I've set out, I hope, at the beginning, which is why initiatives like the Department for Work and Pensions clarification in 2018 of fiduciary duty for trustees being definitely having to consider climate risk and climate change. Those kinds of policy initiatives are incredibly welcome. So we have to look at the way this system is structured and set up. I've acknowledged twice already that the core is making sure that the real economy incentives reward the right thing in the long term. It needs to pay to keep it in the ground, if I can put it euphemistically. We need to make sure that those stranded assets, actually we move to a system where we stay within the inner bubble, the blue bubble, if you recall that former slide. But this system needs to be better understood, better analyzed, this financial services system, the way money flows. And as you can see, if companies are growing, then so will your pension saving and investment. But we need to make sure that pensions grow in a way that doesn't breach the one planet boundary condition. And historically, we have begun to do that. Some would say since the early 80s, the Living Planet Index suggests that it's since the early 80s. And that feedback loop then from the ecosystem, literally from the natural world, back into pension savings and investments isn't something we can ignore. Yet every discount cash flow analysis that I have seen assumes away externalities, assumes that future generations' interests can be discounted. There are good reasons for discounting as well as bad reasons. And then we have a terminal value that in many cases assumes this institution will continue to grow forever at the mean growth rate. Those three assumptions from a sustainable development perspective are absurd. Now, I want to take you through now to some of the work that we've done, and I'm going to canter through a few slides here. We vote a lot. We voted on climate change since 2001. We will withhold support for a company's report and accounts if it doesn't include material climate data. I believe we were the first in the world to embed the TCFD in our approach there in 2019. We also file shareholder resolutions. Those are harder, but we don't do them thoughtlessly. We filed, for example, with Hermes and Legal & General at BP's AGM last year, having been part of shareholder resolutions before. Some of you will have seen BP's work last week, which is beginning to respond to what we've been asking for. BP has, in some respects, been leading the industry. But I do recall 2 decades ago, they were supposed to go beyond petroleum. That clearly didn't happen at the speed that was then intended. Now, on the next slide, I've already covered some of the reports that we've done. So I'm going to go to our portfolio warming potential. The one fact that when we did our TCFD report that scared me more than words can properly describe was when we discovered that the London Stock Exchange, the embedded global warming potential, or the implied temperature change of the London Stock Exchange was 3.8 degrees. Now, our own portfolios are better, but as you'll recall from the first set of slides, 3 degrees still leads to a very broad dieback in the rainforests, and 3/4 of our planet experiencing temperature change that they can no longer live in. Now, this 3 degrees does not give me any pleasure at all, the fact that it's almost a degree better than the London Stock Exchange. I also want to emphasize that we could reduce that to 1.5 degrees tomorrow, but you don't actually do a thing for the planet if you simply walk away from the companies causing the problem. So you might even cause a bubble in the renewable energy space until the real policy measures are shifting. And then the final 2 slides before we open for Q&A. The money that's required. This is an estimate. This is saying if we are to hit 1.5 degrees, we need to remap, as they put it, money. We were expecting 95 trillion to flow up between 16 and 2050. It needs to be nearer 110 trillion. So you can see the delta there. But there's 370 trillion in the world's capital markets. It revolves and it revolves and it operates annually, not just over that kind of time frame. So we've got the capital, we've got the science, we've got the institutions that are capable of providing capital at that kind of scale. But what we lack, if I can have the next slide, is a plan. We don't have an international platform where multilateralists routinely meet capitalists to shape how markets flow. We miss, if you like, a capital raising plan for the planet, or a Marshall Plan for the planet. What we really need, 5 years after the Paris Agreement was struck, we don't have a clear view on exactly how much money is needed, or more importantly, where it's going to come from, in order to deliver our transition to a 1.5 degree world. Now, I'm proposing that COP26 is part of the solution here. We think the presidency could require financial institutions to set out their own institutionally determined contributions, a 5-year vision with annual reporting and a triennial stock take, just as countries have to with their nationally determined contributions. We're also proposing that countries be invited, be hard to require them, but be invited to add a capital raising plan that's a properly market savvy way of moving money, investment grade policy around how they change the real economy, and also a plan for how they are going to mobilize the assets required for whatever infrastructure is implied that is required to be built within their own member state. Now, if you can imagine financial institutions setting out their institutionally determined contributions and countries setting out their investment appetites, and then a forum, this perhaps international platform for climate finance, making the connections, seeing where the opportunities exist, where perhaps the money could flow faster, and also holding both multilateralists to account for delivering the real economy changes that are required in terms of the incentives in the system through directives and regulations and standards and subsidies and taxes, holding them to account there. And then in return, holding the financial institutions account. There are now hundreds that say they support the Paris Agreement. It is very hard to see in a comparable and consistent way whether they genuinely are doing anything of substance to deliver on that commitment. So that's the kind of the kind of broad pitch, if you like, what we need to see in Paris. We're also working on an app which will hopefully harness and re-democratize assets and enable our end consumers to see what they own in their pension, how their vote was used, and how the companies they own compare and contrast. And this is looking at SDG 0 hunger, but it may as well be looking at SDG 7 on climate change and renewable energy, or SDG 13 on the Paris Agreement. So that's, I wasn't hoping to use that slide just now, Michael, but as it popped up, I thought I'd talk about it. If I can have the previous slide, which is where I really want to focus the conversation. How do we shift the multilateral system so that we have a Marshall Plan for the planet? Michael, back to you.
Wow, that's absolutely excellent, Steve. Thanks so much. We've got lots of questions out here, and we're not going to have time to cover them all, but I will indulge. And as we started late, I might let it go a little bit faster and longer, given the clear interest out here. So let's start with a quick question. Could you just give a little bit more detail about this international platform? The folks out here are quite interested in that. But I think what they'd like is what specific things would you see it? Is it comparable to a stock exchange? Are you thinking of this as just an information sharing resource, or how are we going to get this multilateral platform to do real things?
Sure. I first started going to the COPs back at COP6 in Bonn in '99. I've been to, I think it's half a dozen since then. There are about now 30,000 people that turn up for the COP. Only about 1,000 of them are actually involved in the negotiation. Everyone else is trying to understand what's going on in the main room. So what I'm thinking about is how can we, all the finance people that turn up and then have to read the FT to find out what's going on, what we could build within the COP process is a quasi-informal oversight mechanism where you've got the financial institutions are only allowed to be there if they've set out their institutionally determined contribution and then done the annual reporting. It's one practical way we could use the actual physical COP meetings. There are other practical suggestions too, but the main reason why we need this international platform, we need a vision for how much money is needed, where is it going to come from, and how do we make sure that the global markets ensure that the money flows into developing countries as much as it's in developed too. Now, I think it's plausible. We've built a coalition. Others are welcome on this call. Others might wish to join a coalition. It's just an informal coalition talking about how this kind of a thing might work. Between now and COP, what I'd expect is that we help the COP policymakers understand what does a capital raising plan actually look like for a nationally determined contribution. We also need to set out standards for what institutionally determined contributions look like for from financial institutions, and then build, it's kind of like a first mile public good investment bank, which coordinates the international investors who want to put their capital to work to deal with adaptation and mitigation investments, coordinates those with those that wish to see that money flow into their system. So it's big, it's broad, and it's a glue that holds together a vast number of different initiatives, all doing good work, mostly all doing good work, but all of them subscale, demonstrably subscale, because we haven't got the capital flowing at the moment.
A number of really good comments out here. There were some questions early on, and then I've got a few in saying that your financial system chart has probably answered their questions, and this ability to look at the system in the round seems to be almost the most important thing. To give kind of an odd example, in a way, we're looking at areas, for example, in the UK. Andrew Ross is curious, why are UK municipalities so far behind the world in issuing green bonds and communicating with taxpayers and ratepayers? And meanwhile, we've got UK local authorities declaring climate emergencies. So this ability to look at the system in the round is definitely important. Liz Thrussell's kind of curious. How will these initiatives link to the stakeholder capitalism initiative? And would you agree that brokers might have the largest impact?
I'd agree they might. I'm not sure they will. In fact, I think central bank governors have a role to play. Finance ministers, if that group can be made to really work, getting treasuries to internalize the externality, that's probably the biggest, most important challenge. We need a cost of carbon way higher than we have at the moment, even trading in a kind of better emissions trading scheme price. It needs to be, the IMF is even estimating 70, 80, I'd say a couple of hundred soon. So yeah, I think the main forum for me would be the finance ministers. There's, again, huge concentration in the investment banks. A lot of them are US. So the November binary event of the election matters enormously. But yeah, I think the investment consultants are really key here too. So are the stock exchanges. We've all got a role to play. And this climate is an enormous challenge. Climate change is an enormous challenge. We all need to do everything we possibly can, recognizing this as an emergency as befits our own institution. So investment banks matter. on stakeholder capitalism, there are literally hundreds of initiatives that need to work together to power that transition. There's no mechanism bringing them together for conversations about how they optimally collaborate. I could list literally hundreds of them. I'm not going to bore you all with them now, but each one of the institutions, particularly NDC partnerships, the Net Zero Asset Owner Initiative, the Climate Policy Institute, Carbon Tracker, there are some really, really important ones that are doing good work but are subscale. They need to be invested in as institutions and then brought together through these forums. And whether the International Platform for Climate Finance itself needs to have a fiduciary and become a coordination mechanism. Personally, I think it does. If it is going to be created as a discrete platform, then I would hope that it doesn't get created inside the UNFCCC process, because that will then mean it has to operate by consensus. I'd like to see the UN Foundation be the fiduciary, because then it can operate much more nimbly, but still be close to the UN. So I hope that answers Liz had two questions.
Yes, one of the great things about lockdown, of course, is the conversations are wider. Bob McDowell is dialing in from the Channel Islands, and he's curious, will responsible investment place financial investors in increasing conflict with parts of the world where immediate prosperity is of more importance to electors and government, perhaps, than responsible investment?
So I've worked in responsible investment since I started at WWF looking after its own reserves in 1995. And then I've worked on buy-side fund management, 3 different institutions for the last 20 years, 14 of them at Aviva Investors. The thing that causes me most personal discomfort is, firstly, we're making more money for people with money. So there's a kind of an inequality issue. So responsible investment does exacerbate that. And then secondly, if we're providing more money to our customers, of course, which is our job, what do they then spend it on? Is it more consumerism? And is that material consumption? Might it add to the problem? So I think the honest answer to Bob is yes. There are places where responsible investment, pretty fundamental places where responsible investment comes into conflict with the real development needs of developing countries and developed markets, as suggested by the Sustainable Development Goals. Now, these are market failures that investors can't correct by themselves. And that comes back to my main thesis here, which is that investors need governments to correct the market failures so that we can invest in a way that's genuinely sustainable. Clearly, we can look at inequality, whether it be gender, ethnic, or even age, and the dimensions of development, international and local, when we invest. But at the core, there are issues.
It's interesting. Here in the City of London, we're quite proud of our early role in 98, 99 in terms of getting the carbon trading going. The ideas largely emanated from America and went into Kyoto, but here in the city, we moved it forward. Alice Chappell has an interesting question about the role of the carbon price. She asks, U.S. voices, including a recent report for the U.S. Commodity Futures Trading Commission, point to carbon trading as the key to enabling the financial system to respond to climate change. Clearly, this has failed short in the past and has really only worked in sub-international situations, and the carbon price has always been too low, as you mentioned. How big a role do you expect this to play in the future? And I just add in, Zal Limboala is asking, how much of a setback might you estimate from the wrong administration in the U.S. being selected in November? Bit of a loaded question there, but the carbon price and its role going forward. Interesting that the U.S. is picking that up, and any comments perhaps on post-November?
So post-November, that's the biggie. It's interesting that if you go back a decade, President Trump then, when he was simply Donald Trump, signed a series of letters that went to Obama in the run-up to Copenhagen. And Copenhagen, as many of you will remember, was expected. There was some genuine hope that they would deliver what was ultimately delivered in Paris 6 years later. And then Donald Trump's position was that Obama needed to come back with a positive deal on climate change for the American people. Otherwise, the American economy would be at risk of losing value, of recession generated by climate crisis, and indeed things like fire in California. Now, we're obviously seeing that now, but his own position is the polar opposite of what he was articulating 10 years ago. So that's just an interesting observation on the man and his flip-flopping position on climate change, whatever's politically expedient. Now, on the November binary event, what I meant there was that we have Ursula von der Leyen in the Commission talking about a Green Deal and investing at scale, it would appear. I mean, really, really interesting plans coming forwards. Proper money. Now, that would be matched by Biden and then some. So if we see Biden come in, this is the stuff for me of hope. That election really, really matters. And a Biden White House, given that those next 5 years will be so incredibly important, the science tells us it's so incredibly important. I know exactly how I would be voting if I was a US citizen, and I really hope that we get the right result for the climate and for future generations, which as a personal view is definitely Biden. I don't think I can be clearer than that, Michael, on that one.
I think that's pretty clear. And the carbon price.
Sure. I believe there's a role for fiscal measures and carbon trading. I think a tax creates a floor. Carbon trading with a tight cap on top of it should then create the right kind of incentives to mobilize the market. I used to cover carbon trading when I was an analyst 12, 13 years ago, and remember the huge volatility in the listed carbon traders, Camco, Eco Securities. I could carry on. So the carbon trading is conceptually accurate and right. And unfortunately, it's exposed to political tinkering, and the cap has never been tight enough. Getting the tight cap really tied down is important. So I think to ask Alice to answer Alice's question, and Alice, hi, it's an important part, but we need every tool in the kit, whether it's fiscal measures, voting at AGMs, stewardship codes, listing rules, governance codes more generally, rewriting prudential regulation, whether it's for banks or for insurance companies. We need everything now to be deployed in a climate savvy sense. So as you said, Michael, that systematic approach and that systems diagram and using it as a lens to analyze the whole transition. That's the big challenge of our century.
The board is really lit up, and folks, Steve will be getting all of your questions with your names and emails. So I'll make sure that he's able to get back to you if he can. But I've just got time for two more threads, if we might. The first thread is about countries. Matthew Leach is curious, can a country get an advantage for itself by becoming sustainable more quickly than most other countries? And Stephanie Rochford is asking, what sort of policy approach do you think the governments of resource-rich, especially fossil fuel-rich countries should adopt to ensure a just transition? So a bit of a contrast there.
So the just transition was first introduced to me by Nick Robbins at the Grantham School at the London School for Economics. And I remember saying to Nick when I first heard the concept, I think it's 4 or 5 years ago, we just need to transition. And that for me is justice, climate justice, and the interests of future generations should be as important as the generation today. So the transition remains for me the main thing. The reason why I say that, and I know this is a bit controversial, but the reason why I say that is I know that some of the forces that exist in the system that are vested financial interests in not seeing a transition are using the just transition argument to hold things back. I'm not suggesting for a second anyone on this group would do that, but we do need to focus on the transition piece. Now, in terms of justice, we need to look after the employees, the local communities. We need to make sure that the employees of fossil fuel firms continue to be able to draw down a pension. I think that the resource-rich countries, if the world were run differently and we could do a land, what's it called? The tax that's
a land value tax.
Thank you. If we could apply one of those globally, then that would be the kind of economically effective way of doing that. But of course, tax doesn't work that way. But yeah, I can see that they're refocusing their sovereign wealth funds more and more on renewables, partly around diversity. So we shall see. What the recommendation I would make, and this was to finance the Just Transition Fund, and we have made this to the European Commission. And I do believe that just transition is important. I don't wish to ignore social justice at all for a second. If you were to apply the producer responsibility directives, which require car manufacturers, tire manufacturers, white goods manufacturers, they're required to finance the recovery of the waste they generate in part. 50%, for example, of their waste needs to be funded. These take-back schemes have revolutionized recycling and recovery across Europe. We need the same mindset applied to fossil fuel firms. Just because the waste is not physical, it doesn't change it whatsoever. We need a producer responsibility directive to be extended to them to finance the carbon capture and storage of, say, half of their waste. That internalizes the externality at source and generates a market mechanism for why they should finance CCS, which is woefully inadequately delivered right now, but also generates a revenue stream, which then could be used to fund the pensions of the employees of the fossil fuel firms that would otherwise be tested, as well as their salaries as they're retrained, as well as the local communities that would otherwise be displaced. So extending producer responsibility directive, I think, is plausible under Ursula von der Leyen. Does that address your question?
I think that does. We've got a lot of things out here, but I'm going to focus on two quick questions. But I'll just give you a flavor of what's happening, folks. A lot of discussion, Hugh Purser, Henry Winnon, about the long term and the short term. With Henry curious about the role of reinsurance and its good focus on largely physical assets. Could we use that to scale up better? Some points here from Lasse about climate illiteracy, like Germany shutting down all nuclear for coal. If climate change really is the big issue, where does nuclear fit in that? Some comments from Anita Miller about carbon engineering and what's the future there of actually direct air carbon capture tech. So a lot of things out here, but just two. A specific question from Edwina Morton. Edwina is curious, did Aviva make portfolio changes to get to the 2.9 degrees warming potential, or was that just how the portfolio shook out? And do you have any plans to adjust the portfolio to lower that warming potential further?
We do, and I want to emphasize this. It's really easy to just walk away. It's much harder to use your ownership influence to affect change. So a snapshot, that global, the warming potential of the portfolio is a snapshot in time. What you really need is a video played out over time to show how it's fluctuated. We actually went back as best we could to look at previous portfolios. That was the first one we did in the real-time environment. And we found that the embedded global warming potential since 2015 had come down significantly. And I like to think that's because over the same duration, we've been informing and educating the fund managers and the analysts about the materiality of climate risk. I know for a fact that we engaged very actively with the coal firms that we had positions in, and those that didn't commit to science-based targets or no new capex on coal were marked for divestment and then sold. That wasn't a huge part of the portfolio, but it would have had some implication for the embodied global warming potential. And yeah, and in terms of our ambition going forwards, we've signed, not that one, we've signed the Net Zero Asset Owner Alliance statement, and we wish to make our portfolios net zero by 2050. We're currently talking about how much sooner we can do it than that. But I don't want to do it just by walking away. We need to use our voice. Before we vote with our feet, we vote with our vote.
Steve, and then briefly, because there's quite a lot of interest. I'm sorry to have revealed that earlier, but on the app, Chris Stank, Hugh Purser, trying to see here, Jeremy. There are a number of people here. Just 15 seconds on the app, and where's that going?
Okay. 15 seconds. Wow. So I believe the way you resolve the Sustainable Development Goals is to democratize finance and put power back into the hands of the people whose money it is. The London Stock Exchange in 1802, you and I would walk into the exchange with cash in our pocket. We'd walk out with a share certificate. We knew what we owned. We'd vote similarly at the AGMs. Now the reality is, a few hundred years later, hardly anyone knows what they own. There must be ways of correcting that, and there are. We've been working with an organization called Tumelo for a few years now and have helped them build an app which provides access to the portfolio, the equity part. How have we voted? How might they wish we vote differently? And then in parallel, we've been working to build the World Benchmarking Alliance, which builds free league tables ranking the world's largest companies, including those, on how they impact the Sustainable Development Goals. That's impact rather than how does the ESG issue hit their cash flows. So it's very definitely the former. And for me, that's how you democratize finance. People care. What they don't have is the information, firstly, at their fingertips, or the ability to exercise their vote. Literally, this is how you democratize finance.
Okay. Well, we'll try and get a link to that posted on the site for everybody.
Yeah, it's in beta testing right now. It's what's coming. It's not yet here.
Okay. Well, then we'll do it when it comes, which is great.
Yeah.
Steve, I wish we had more time. You've been so generous, and although you thank the audience, it's we who need to thank you. And if I may, just if I can pause for a second, I've got two other rounds of thanks to do. The first round of thanks, as ever, is to the sponsors who, as I've expressed earlier, are extremely generous in allowing us to range over topics, although I don't think anybody can doubt the importance of this topic. You did a good job of combining fear and greed in this presentation. I'd like to see a little bit more greed, oddly, which means we're starting to do things rather than the fearsome bit. So this was very nicely balanced. I'd like to thank the audience. As said, I will get all of those questions and comments to you, to Steve, that is, so he will have them. Just a reminder that we've got quite a few things coming up. Bright and early tomorrow morning at 8 o'clock, we are launching Global Financial Centers Index 28. Given the state of COVID, there are some really interesting insights in what the future of financial centers might be if you wish to kind of examine the entrails of the numbers. We'll be looking at employee share ownership on Monday. We have a bridge between the Golden Gate and Tower Bridge that we'll be looking at on Tuesday. What's the fintech investment corridor between San Francisco and London, and which way does it flow? And finally, we're going to have Benoit Lallemande on from Finance Watch in Brussels, and he's going to be discussing the future structure of the magic money trees in the EU. So lots coming up ahead. Steve, as I mentioned, has on the slide deck a quite extensive appendix. So if you go there and have a look at the slides, much more information there for all of us to consume. But Steve, it is to you I must give our thanks. And I'm terribly sorry in this age of COVID, I'm unable to open up and show the warmth of the applause and the comments that I know the audience have already given. But I will give you, if I may, my karmic clapper from my Buddhist temple in Korea. And so my Korean
that is most generous. Thank you, Michael.
Thank you.
I'm very, very, very flattered. I would return with my Tibetan singing bowl, but it's a little bit out of reach.
Yes, and my long player one, no less. But we're looking forward to having you again, because this is a topic that is of great interest to all of us for the very long term. And we wish you the best. We'd really like to work with you on developing that financial platform, where I think you've made some very cogent points that we've really got to start getting that overall view. And I know a number of people were particularly impressed with the way you pulled that view together today. Thank you very much.
That's very kind of you. It's been a huge pleasure, and thank you to everyone for dialing in and for watching. And Michael, again, thank you to you and Peter for all your help and for the original invitation. I look forward to the next one. Take care.
Thank you.